You're not just forecasting one interest rate cut. By the end of next year, between now and the end of next year, so 18 months' time, you're forecasting 5 cuts in interest rates, bring the cash rate down by 125 basis points.
Yeah, look, that's right. I mean, these rate hikes and rate cuts move in cycles, and you don't get once we get an easing cycle, it won't be just one interest rate cut. It'll be several. Our thinking here is that where the cash rate is right now is quite a restrictive setting. In fact, if the Reserve Bank was to leave the cash rate unchanged over the next 2 years, as all the fixed rates out there, fixed home loan rates roll off, mortgage repayments would actually rise to a record high as a share of household disposable income. So what that means is where the cash rate is at the moment at 3.85% is actually highly restrictive. So our thinking here is that as the unemployment rate is drifting higher and inflation is coming down, then at some point the Reserve Bank will want to move monetary policy away from that restrictive setting and take it to a more normal interest rate. And we think around about 125 basis points worth of cuts will do that. It's very hard to pick exactly when they will deliver that first cut, particularly when in the short run there's still the risk that they go higher. We've penciled it in for the back end of this year. It could be next year, but our thinking is once the easing cycle gets underway, we're looking at around 125 basis points of easing.
I'll tell you, it's going to be a pretty interesting welcome relief for some of those people with mortgages, maybe not so much for those with fixed interest investments. Gareth Aird, Head of Australian Economics for the Commonwealth Bank. As always, many thanks for your time.
Cheers, Ross. Always good to chat.